In this video, we'll analyze the trade-off between fixed and variable rate bonds, one of the most common problems in public finance, and we'll look at it using a metric known as cash flow at risk. First, we'll enter a hypothetical new fixed and variable rate bond structures into Smart Model Stage 3, and then we'll do a single scenarios calculation with 20 different amounts of fixed and floating to create a chart of cash flow at risk versus expected cost measures. We'll do this by entering fixed and floating rate bond structures, setting up our scenarios calculation, calculating and graphing results, and then repeating the calculation and graphing step after entering an amount of cash assumed to earn LIBOR. Our risk measure will be cash flow at risk, and cost measures will be average annual debt service and portfolio yield. Let's get started. We open up the Smart Model Stage 3 file that we've set up, and it has just two structures in it. The first is the fixed rate debt on the Basic Inputs tab. You can see here we've set up a 20-year analysis on a semi-annual basis. And off over to the right, you can see on this page that we've entered $100 million of a proposed new fixed rate transaction, which has about $34.46 million in total interest. Principal and interest is entered here semi-annually. On the next tab over, the Cash Flow Structures tab, you can see that we've entered just one new bond, and it's a variable rate bond, which we've set up as 100% a SIFMA. We've added 50 basis points for support costs. Now we want to set up our scenarios. In order to see the Scenarios tab, we go up to our Views selection and select Scenarios. When we do that, we see this Structure Scenario tab available. And what we have here is a way to generate various statistics from multiple different structural alternatives, all with one calculation. In this case, we'll vary the amount of fixed and variable rate bonds. Before we get to that, let's review how this works. There are two types of structure scenario calculations, aside from the off selection: percent changes and amortization changes. For this purpose, we'll use the percent changes and leave the amortization changes for another video masterwork. The percent changes selection applies a percentage to the outstanding amount of a structure, whether it's fixed or variable rate bonds, a swap, or an investment holding. We set the number of changing structures to 1, though we can change up to 7 structures in a single scenario. The main calculation, with all the structures as entered on the respective input sheets, is scenario number 1. So we always start with scenario number 2 on this tab. For example, if we enter 50% here in D16, we've now created a single scenario where half of the principal and interest on our variable rate bonds are calculated. This is an extremely general and powerful bit of scenario functionality that hopefully you see will save tons of time when comparing different alternatives. For this example, we want to run 22 different scenarios. This will allow us to go from 100% of our entered variable rate bonds down to 0% of those bonds in 5% increments. At the same time, we'll start with 0% of the fixed rate bonds and increase their percentage by 5% until we get to 100% for our 22nd scenario. Before we calculate, let's look at the statistics that we'd like to see for each scenario. These selections are over on the Structure Scenarios tab, or Struct Sens, on the output sheets. We've got 4 elements here, 4 statistics that we'll calculate for each one of our 22 different scenarios. The first is cash flow at risk. This is the maximum cash flow at risk at the 95th percentile. The second is debt service volatility. This is one standard deviation for debt service, and that will be the average of that calculation across the entire simulation. The third is the expected dollar cost on an average basis, which many people know better as average annual debt service. And then last, we have the expected capital cost, which in this case, when it's calculated as an average, is effectively just the portfolio yield for the instruments in the calculation. Now let's hit Alt-S-C to calculate and get our results. And now we see here, for each calculation, and we'll start with scenario number 2, which is the one that had 100% variable rate bonds and 0% of the fixed, that our cash flow at risk was just under 1.4 million. As we decrease the amount of that variable rate bond, our cash flow at risk, as we expect, decreases. The same with debt service volatility. We decrease here from about 550,000 in the case where we're using all $100 million of variable rate bonds down to zero when we're not using variable rate bonds at all. And similarly, our average annual debt service starts at just under 6.2 million on an expected basis for the all variable rate structure. And then as we continue to decrease the variable rate component and increase the fixed rate component, we get up to about 6.7 million of average annual debt service when we do all fixed. Our overall expected yield is about 2.05 until we get to the all fixed rate structure when it's just over 3% for the 20-year amortization that we've looked at here. Now, if we copy the cash flow at risk and expected dollar cost over into a clean Excel file, we can easily create a nice scatter plot of risk versus average annual debt service. And the slope of this line is telling us the trade-off between risk on the horizontal axis, which is cash flow at risk, and cost on the vertical axis for this product. That is the trade-off risk versus cost for variable rate bonds. We can also do a quick calculation down here, very similar to a Sharpe ratio in the investment world, which is the expected excess return above the market for an investment divided by its volatility. In our example, the incremental change in cash flow at risk for each reduction of variable rate debt by 5% will be $68,800. If we look at the same reduction in average annual debt service, as we increase the amount of variable rate debt, we get a reduction in average annual debt service of $26,745 for each 5% increment increase in variable rate debt. If we divide the reduction in cost by the increase in cash flow at risk, we get a variable rate demand bond product efficiency of 38.9%. It's a very interesting exercise to evaluate interest rate swaps, basis swaps, fixed pair swaps, other variable rate products, index products, based upon this methodology and product efficiency ratio. Now let's go back to the Cash Flow Structures tab and add back an investment, assumed to be cash holdings, that are used to hedge the variable rate debt that we're analyzing. In this case, we're going to assume that this cash earns 100% of LIBOR as modeled on the market inputs page. The amount of cash we're holding is assumed to hedge a fraction of the variable rate debt as it amortizes, in this case 50%. Now if you run our calculation again, we'll see that our cash flow at risk has been more than cut in half by that cash holdings. And in fact, we see that cash flow at risk decreases, starting with our 100% variable rate debt, goes down, and then starts coming back up again, ending about where we began at around $600,000 of cash flow at risk, even with 0% variable rate debt, which is this 20-second scenario. Our average annual debt service, or expected dollar cost, starts at $5.5 million with a 100% variable solution and winds up at just over $6 million. Now this average annual debt service is net of the investment returns and interest income from those cash holdings. If we perform the same copy and paste in order to get our chart, we see that now the graph looks a bit like an efficient frontier in the investment space. However, this is really not. It's really just a number of individual scenarios that are leading to a minimum point for the cash flow at risk measure, which is on the horizontal axis. And now if you notice, our incremental change in cash flow at risk for each 5% increase in variable rate demand bonds results in a $51,000 change, whereas average annual debt service changes still by the same amount, 26,745. Not surprisingly then, our product efficiency for variable rate demand bonds, when you're including a certain amount of cash on the balance sheet, goes up, specifically from the 38.9% we had prior to including the cash to 52.4% that you see here. This is an extremely powerful approach to looking at one of the most common questions in public finance, fixed or floating. It's even more enlightening if you have a mix of variable rate products, swaps, and other investments. That concludes what we wanted to cover in this video. If you've got any other questions about Smart Models applications, please shoot us an email or give us a call. Thanks.